Hi, I'm Steve Redd, owner of Red Summit Ranches and founder of Red Summit Advisors. Growing up in the West, growing up on a ranch, having this be generations deep for me, I've heard my whole life the stories about what it's taken to survive, what it's taken to thrive. I've seen great men, great women, great families work really hard for what they have, many of them be on the brink of disaster. It's impossible to experience that and not have it have a deep impact on me, and even on my desire to help other ranchers, other ranching families stay on the ranch. What I love about being an agent and owner of Red Summit Advisors is getting on the ground, meeting the ranchers, helping them recognize and see what PRF can do for them. PRF insurance was created for the livestock producer, specifically for you. If you own livestock, this is the one program I know of that was created specifically for you and to keep your family on the ground. It's designed to pay you an indemnity when there's a shortage in rainfall.
When I got my first check this year, I texted Steve, I'm like, is this thing gonna be good when I put it in the bank? Because there's a significant amount of money involved. I was joking, but a little bit serious, also wondering if it was going to be good, and it was good. Having this insurance, and especially on a year like this, it's helped fill in those gaps a lot. We don't have to worry about, how we're going to buy the extra hay, how we're going to pay for the extra pasture that we might need, how we're going to replace extra cows if they don't breed back. Yeah, having the insurance does give me a lot of peace of mind, just knowing that if there is a lack of rainfall, that we will have a check coming that will help pay for a lot of the extra expenses that we will have.
PRF insurance is more relevant than ever because raising livestock and being a profitable rancher is far more difficult than it ever has been. PRF has been around for over 10 years, and those who have utilized the program wouldn't be without it.
This isn't a risk, this is a long-term wonderful benefit. After that first year and looking back at what that drought insurance helped us do, the leeriness is gone and the excitement for the future is there.
We want you to be successful. This is not a sign here and then we'll see you next year. We're in this with you throughout the year and always available. If you're considering PRF insurance for your ranch, give us a call. Let us show you what it can or can't do for your family, and we can get you started.
Good afternoon, I'm Steve Redd. Hey, thanks for enduring that, and thanks for enduring a little bit of what probably feels like a sales pitch here, and I don't want it to be that. I just want to educate you. There's probably, if I were to guess in this room, there's probably about half of you understand it and use it, and the other half who don't. And of the half that use it, probably 60% of you have had a good experience and 40% haven't. I don't know, that's my guess. PRF is, we throw it around like it's, everybody should know what it is, right? We joke around the office that it's PRF. You got PRF, right? It's pasture, rangeland, forage insurance. I didn't know what it was almost a decade ago, and I stumbled into someone who's now a great friend at, I think it was at the NCBA convention in Texas, and I was tired. It was the end of a week. I was just trying to get out of there without talking to one more darn vendor trying to sell me something, and paid and pulled up a screen and told me I really ought to do this. And although he did not even understand what an AUM was, which is a big deal for us out here who run on federal ground, therefore I didn't believe anything he said very much. Fast forward 10 months, I wanted to believe it. It looked pretty good. Fast forward about 10 months, and he was smart enough to drive out to Utah and camp in a hotel room for 3 days while I was weaning calves before I was willing to give him any time of day. Fast forward about another year, and I had bought my family out. My dad had borrowed way too much money, and it was a tough year. And this silly little insurance that he hooked me up with was the difference between me having a very difficult workout type of situation with my banker and being able to make my payment that year. And that's when it clicked for me that maybe this wasn't just, wasn't just a fluke and that it was real. Let's see if we can get this clicker to work here. You guys have already watched my kids ride on horses there. But PRF it stands for Pasture, Rangeland, Forage Insurance. It's really about covering rain. You'll hear people call it drought insurance. It's not technically drought insurance, but that's what tends to resonate with people. I don't want to bore you today. I want to give you some nuggets that you can take home, or if you're already an expert, hopefully I'll teach you something new. I have a few stats that are kind of interesting towards the end of the presentation about how much it's being used, how does it fit into the farm bill, that kind of thing, 'cause that's often a question of like, hey, this looks too good to be true, how is it funded, that kind of thing. So let's just, this is actually something on one of my personal ranches, and if this was a profit and loss statement, right, the green would be profit, the red would be a negative, right? It's insurance, so it's not profit, but this is the kind of thing that caught my eye originally, right? And we'll jump to that a little later. But Gabby, would you go ahead and play this video? We've got a 7-minute video. It's going to describe PRF, how it works, and then we'll talk a little bit about it.
Pasture, Rangeland, and Forage Insurance, also known as PRF, specifically designed to protect the hay grower and the grazing guys. Row crop farmers have had subsidized insurance for years. PRF is designed for you. PRF is a heavy buy-up coverage that has previously been unavailable through NAP. Most of you would be familiar with the livestock forage disaster payments or NAP payments on your hay and grazing acres. With NAP, the county has to have a 50% loss for it to kick in, very low-level catastrophic coverage. PRF is a similar concept, but it is going to let us purchase all the way up to 90% of a 70-year average rainfall. Deductibles range between 10 and 30%. There are roughly 600 million acres that are eligible for this program. PRF is area revenue protection. It is not individual rain guarantee on your pasture. PRF is available for hay crops, whether it be grass, hay, or alfalfa. It's also available on your grazing acres. The only distinction is between grazing and hay. PRF is now available in all 48 contiguous states. Let's look at how this program works. Each little red dot on this map represents a NOAA-approved weather station. There are over 9,000 weather stations, with more and more stations being added each year. It's impractical to monitor all rainfall in every location, but a very good job can be done monitoring precipitation over a general area. RMA sets a base value per acre for grazing value. If RMA sets a grazing value of, let's say, $10, they will let you buy up to 150% or $15 an acre, or buy as little as 60% of that $10 an acre value. You do have flexibility on the dollar amount covered, but the base value is fixed and set by the RMA. Rainfall index is all based on a grid system. The grid lines run on longitude-latitude lines, and each grid is a quarter-point longitude by a quarter-point latitude, roughly a 12 by 17 mile grid, depending on where you are in the country. This is why we refer to it as an area revenue policy. We are insuring for lack of rain on any acre you have that fall between that 12 by 17 mile grid. Let's say your ranch is down here in the corner. Now your grid gets 1 inch of rain, but it all falls up here on the top. This is where the smoothing process comes in. They take 4 closest NOAA Doppler weather stations and identify where the rain was, and spread it out. The southern stations are reporting no rain, while the northeastern stations will have seen 1 inch of rain. You will frequently get rains that the grid misses, and you will miss rains that the grid gets. But since they have to smooth it out over the whole grid, you will find, year in and year out, that the data is very accurate and very fair. You will find that guys who have been using this for 5 years or more and watching the rain have no complaints. Also, the ease to be in the program versus the data they use to administer the program balances out to be pretty fair. All the data is collected by NOAA and reported to the insurance companies. Now that we have that figured out, let's look at how the program is used. Most areas have 2-month intervals starting in January and ending in December. you have 2-month intervals throughout the whole year that we can put coverage on. The rule here is that you can't double dip on the same month. Generally, you have to put at least 10% coverage per 2-month interval if you choose to use it, and at most 70%. The maximum ranges between 50% and 70% depending on your county. You will find the better risk management is possible when you spread coverage instead of dumping all coverage into 1 or 2 intervals. So how do we use PRF that sets us apart from others? We use software called RangeCalc, which takes those 2-month intervals in the whole year and combines all the NOAA data being used for the PRF program. We tell RangeCalc to pull the last 20 years of data on your specific grid. It starts running calculations to show us the best way to use the program based on percent of payment and net loss payments. So what the software is doing for us is taking these 2-month intervals and finding where the volatility lies. Here is a great example of this. Your first instinct is to put all coverage on June and July, which makes sense since historically they are the driest 2 months. However, they are not necessarily the most volatile months. Your driest interval is not always your most volatile. RangeCalc is showing us the volatility, shortfalls in rain that trigger payments. So we are able to use historical data to make informed decisions on the best way to manage your dry weather risk. PRF requires you to sign up by November 15th of this year for the next year's policy. A nice benefit is that premiums are not due until the end of September, after the end of the crop year. No money up front. What can happen, if you have coverage in March, April, and it starts out extra dry, and you trigger a loss in that interval, they're going to take those lost dollars and fund the policy, meaning less or no premium payments. Note, rainfall data is not released until about 60 days after an interval ends. With RangeCalc, we can show you exactly what the past would have looked like for you using PRF, bringing visibility to your decisions. There is no reason to gamble on the weather anymore. Let us help you manage your dry weather risk.
So now that you're all experts, we'll have a quiz, right? Actually, we'll just walk through a few of these and I'll just fill in a few gaps. So, number one thing is, it was created for you, right? This was not created by big insurance companies as a way, like traditional insurance, to get a little bit of money out of you, right? It was created by the USDA. This video, and you'll hear me reference RMA, that's the Risk Management Agency. If any of you don't use PRF, but have corn or soybeans, you probably do crop insurance, right? So you're probably familiar with it, right? What we found a lot of times is where we specialize in it, we go deep, we're PRF nerds, right? I mean, I never in a million years thought I'd be standing up here, right? I am a rancher to this day. We still have ranches, and that's where I love to spend my time. And here I am talking about a USDA subsidized program, right? And politically, you probably don't need to know too much to know that, like, I tend to be to the right of the stage. So far right, there's a cliff right here, right? And yet here I am talking to you about a subsidized product that I really believe in because of who it's for and because of how wonderful the government is at messing everything else up. Here's one of the few gimmies as far as I'm concerned. So just in review, you know, some of you are probably familiar with NAP from the FSA. That's really a catastrophic thing. It's not designed for when it's just a little bit dry, right? This allows you to insure from 90% down. So if we look up here, we're dealing with an insurance that is trying to get you paid for the deficit between however dry it was this year compared to a 70-year average. So the 70-year average is the other thing that makes it work. It's not working off the last 10 years, whatever. It's 70 years, right? And so that average can be kind of high. This is a slide. I know it's old. I know there are more weather stations than that now from when this was taken, but so it uses those weather stations all over the nation. And here's a picture at my home ranch here, and each of those grids you see there is one of those 12 by 17 rainfall grids. And while this isn't true, think of it this way, just to get your head around it. Think of each of those squares, each of those rectangles as a virtual rain gauge, right? Think of it as a virtual rain gauge that has its own history, its own 70-year history, and it's actually more complex than that. It actually has its own 70-year history in 2-month segments, right? So think of those as a weather station. So the other thing to remember, and I'll bring this all together, it's predetermined what your grass is worth, right? Depending on where you live in the county. You guys from Missouri have a lot more grass than I do in San Juan County, Utah, right? And it's adjusted accordingly. Just like you can't have a small trailer and insure it as a $100 million mansion, right? And they've done the same with the grass so that it's all standardized that way. So you've got these grids all over the nation. Here we are back to this again. Let's just look at this one here in the bottom left. If you can read that, it's the 21683. Let's just pretend that we're using that one. We're looking at the data on that one. And you see those 4 raindrops? Those are 4 weather stations. Those aren't actual, just put them there, right? That's a representation. It's going to use each of those 4 weather stations in an attempt to average what the rainfall was for that area and take a butter knife and spread it over the 12 by 17 miles. It's never going to be perfect, but it will be consistent. So, and then the other thing, I guarantee there's people in here who have had an above average water year that have PRF that actually ended up getting paid, right? How can that be? It's because of these 2-month segments. It's actually like having multiple tiny policies, 2-month policies throughout the year. So you can have coverage in January and it be very dry. And then come April, May, you have coverage and it's incredibly wet. Maybe you have 300% of normal. It has no impact on the coverage you had earlier. You get paid on the coverage early in the year, even though it was wet late, and vice versa. Let me just show you an example. And the video mentioned you can't double cover, right? So February, when we're talking about one grid to keep it simple, you're either going to insure January, February, or February, March, right? You can't do February twice, just to simplify a few things. This is an attempt to show you, if you followed that squiggly line, that's the actual rainfall, right? Whereas the blue line is the 90% level of when it would trigger, to show you that some months it'll trigger, some it won't. Some people think, I cannot buy that insurance. I'm praying for rain. Like this is against everything I've ever been taught. We still want it to rain. We just want it to be normal. We want it to come and go like it always does, where some months are above and some are below. And then this, on average, will pay you. If we were just to look at a few, this is an example. I just grabbed a random grid. This is just about a mile west of the St. Joseph Airport, right? I hadn't even looked at it. Each of those months there for the last 20 years, if you follow those across those 2-month intervals, if it's blank, it means it was above 90% and it didn't trigger any kind of a payment. And I have it on a 1-acre basis, right? So in January, February, you can see the last 3 years, it was above average, according to that weather station, and it didn't pay anything. It did back in 18 all the way through 2013. And you can kind of follow that across and get a feel for it, right? Well, again, you may say, well, this is great, Steve, sign me up. How do we do this? And you say, I really need lots of rain in March, April, and April, May, and I say, that's awesome, but I actually don't know how to make it rain, right? What I do know how to do is set it up that over time, you get a check when it dips below. So one of the first things you have to do is throw away when you think you want the rain and let us look at the 70 years of data and say, let's put the coverage the place it's most likely to trigger for you. So looking at that bottom line there, you see where it says net? That's net to the rancher, right? So just above it, it's a little hard because of where that line came across on the TV, but so in January, the premium is $897. That's how much it costs per acre, right? The payout over the last 20 years has averaged $16, almost $17. Therefore, the net is $7.85. Follow that across and say, no, I really, really want coverage in March, April. Well, that's fine, And look, it's even cheaper. You know why it's cheaper? It's not very likely to pay you. It's cheaper. It pays $570, or it costs $575, pays out $597. On average, it only pays you 22 cents. So you can put your coverage wherever you want, and it's up to you. But that is the biggest single mistake I see people make, is they go, I want to be safe, I'm going to spread it out, thinking you're being safe. But, you know, I have one of my agents hates it when I use racehorse analogies, because this is a lot less risky than that. But it's literally like unknowingly betting on the worst horses and thinking because you're betting on more that you're actually being safer, right? So what we do is we use the software, and we go through and we find the very best months. So in this example, it would be January, February, and then June, July, see at 788, August, September at 760, and November, December that stick out and are just far and wide much better than the rest. So here's an example I think I showed you earlier. So here's an example of one of the ranches I deal with personally. All those red years, that's kind of gross, right? Some of those years are over a dollar negative per acre, you know, and on a 100,000 acre place out here, that's a lot of money. Well, we can run it through the software, and sometimes we make a little bit less, but we can really safen it up to where you don't have as much money due. Let's just look at this real quick, and then we'll bump through this. Here is a statement. So if we had coverage in January, this is just a statement I pulled from Utah. In January, February, and let's just look at that top bar. We had 19% of this individual's coverage there, or $22,000 of coverage in January, February. Think of it as its own little policy. It came in at 50% of average, therefore it triggered a payment of just under $9,000. Followed across, similar things happened in March, April, and May, June. And then look what happened in June, July. It was 123%, 170%. They were thrilled. There's a couple of reasons they were thrilled. They're still ranchers and they still love rain. And second, it didn't hurt their insurance at all. We didn't even have coverage there, right? We knew from looking at history that that's not a good place to put it usually. But also look, it's not like we can predict anything. August, September, we had coverage, and it came in at 103%, therefore it triggered nothing. They got nothing, right? But it didn't do anything to their coverage before to hurt it. So you get to the end of the year on about a $10,000 premium, and this was an extremely dry year, so it's not like this every year, of course. It triggered $55,000, so about $45,000 net on that $10,000, or $2.80 per acre. Because you go east, you're going to sometimes multiply that by 10. That just gives you an idea of those individual policies, think of them, throughout the year. We'll just skip through a bunch of this here. So is this going to stick around, right? And how can it pay out that much? I'm sure some of you are wondering that, right? And it's like flood insurance. Who will underwrite flood insurance, right? Nobody who wants to make money, right? So the government's the only one that underwrites this, and they're have a predetermined amount that they put in, and it's actually performing the way it was designed. So obviously it has to have the subsidy, but it is performing accordingly. And so let's just talk about the subsidies. I think it's kind of interesting, right? Again, I told you where I am on the political spectrum. There's a cliff here. Yeah, here I am. Let's just talk about this. PRF in the nation for 2021, from the USDA's data, about $457 million in subsidies. You can see what it is for the various states. Some things that pop out. It's like, you know, how much crop production do you think of as being in Nevada, right? Yet that's why there's 50 million there. And then you look at states like, oops, I couldn't see it there, Texas at 92. Well, how does that compare to all crops at 8.8 billion? And you know, you look at places like Texas, you know, almost $1 billion by itself, but 10% of that is PRF. Most places it's very different than that. If you go, again, let's move forward here. You know, Missouri is at 333,000 million. In PRF, it was only 5 million. Just to put it in perspective. It's about 6% of total premiums, PRF, but if you look, I like this slide. Of all crop insurance, it's about 5%, right? So it's actually more significant than it used to be. It's grown a lot, particularly in the West, and it's incredibly underutilized as you get east of Colorado. Not because it doesn't work. That's the mindset people have, is they think it doesn't work. It actually works very well, but most crop insurance agents, they're insuring corn and soybean and cotton, big dollar stuff, and a rancher may have 100 or 500 acres of pasture ground that it's not a big policy, it's not very exciting, and so they don't even talk about it, or when they do, they tend to just spread the coverage out, right, rather than dig in deep. And I'm almost done here. So in the Farm Bill, it's about 1%, from the best we can tell. It's about 1%, so it's relevant. We made the scale. In Utah, it's about 3%. There's about 200 million acres insured. That video said there were 600 million available. I think that's a little bit low. As my GIS guys do the math, I think we're a little higher than that. We're proud that we get to work with over 40 million of that. So I've seen it all. I'm working with customers from Florida to California, and there are occasionally places it doesn't work. That is absolutely true, but 99% of the time, it's a good thing for ranchers. If you take a peek here, this is again just for 1 year. Find your state there, and those of you who are farther east, my apologies. But like in Utah in 2021, on average, if somebody had PRF, they'd have made $2.50 an acre. Not a big deal, unless it's 50,000 acres, right? You go back to Missouri, Iowa, $18. It starts getting a little more significant. Again, nothing compared to having a corn policy, those kind of things, but that extra little bit. And this is something I haven't touched on. You do not have to own the land. You have to be the one that has the rights to grazing that year is all. So this is how it works on leased land, anything that, and you're the one that has the cows, you're the one that has the right to this. I think I already took you through that example. Let's get you guys back to your convention. I just pulled 2 examples here, and then I'll let you go. Here's one. It's that same grid with a traditional spread on 1,000 acres that would make on over 20 years. And 20 years is a very conservative way to do it. A lot of people think we ought to do 10, but I'm trying to give you a real picture of what can happen. It would, on average, pay you out $10,700 a year with just a $7,000 premium. Therefore, a net of $3,800. And the pattern looks like that. So everywhere it's negative means you wrote a check rather than the government the insurance provider writing a check to you. So that's real. But that's what I call the traditional spread. That's what you see a lot. Let's spread it out. Let's just kind of bet on all the horses, and it works, right? And that's why you still see it done. Is it still on average puts $3.80 in your pocket for every acre? Well, if we just weight that a little bit, just use a little bit of technology, a little bit of data, we bump that up. We almost double the amount that makes it into your pocket. That's $6,600. And more importantly, we create a history like that by and large, since 2008, the money flowed to you. So that just gives you just a little bit of a flavor. If you're going to pursue PRF, whether it's with us or someone else, make sure it's being done in a way that, because there's this night and day difference between spreading it out and crossing your fingers that you bet on good horses and using the data. We have a booth at the convention center, and one of the fun things we're doing this year, and this is no obligation at all, and we didn't do a very good job on this, blowing this up, but my team has put together these maps. You come show us where your ranch is, and they'll print it on site. It's beautiful. It's the kind of thing you'd want to hang on your wall, and we can hand you a quote as well. No obligation. I told you my background. I've never done sales. Actually, that's not true. I tried sales once in college and totally failed. Tried to sell pavers door to door. But we just want to provide value to you. And if it ends up being good to you, we think there's a good chance some of you will come back to us. So thank you so much.